As we stand at the crossroads of economic recovery and persistent inflation, the Federal Reserve's steadfast approach unveiled this week illuminates a path forward that seeks to harmonize growth and price stability. In a deft display of foresight and pragmatism, the central bank's latest policy statement resonates with a commitment to fortifying the economy's resilience, even in the face of turbulent currents. The unanimous vote to maintain interest rates at their current elevated levels, a range of 5.25 to 5.5%, may seem like a pause in the symphony of monetary policy adjustments. However, it is a calculated overture, one that acknowledges the delicate balance between tempering inflationary pressures and nurturing the embers of economic expansion. As Fed Chair Jay Powell artfully articulated, the economy is performing well, defying the pessimistic prognostications that have lingered like ominous clouds. The projected growth rate of 2.1% for the year, a substantial upward revision from the previous 1.4% estimate, is a testament to the resilience of the American economic engine, fueled by the ingenuity and industriousness of its workforce. Yet, even as we bask in the warm glow of this revival, we must remain vigilant against the specter of inflation, that insidious force that erodes the purchasing power of hard-earned wages and savings. The Fed's projections of core inflation at 2.6% for the year, while slightly higher than anticipated, serve as a sobering reminder that the road to price stability is often paved with unexpected twists and turns. In Powell's own eloquent phrasing, it is a sometimes bumpy road towards 2%, the sacrosanct target that has become the lodestar of the Federal Reserve's inflation-fighting mission. This candid acknowledgement of the challenges that lie ahead is a refreshing departure from the myopic optimism that has sometimes characterized economic discourse. The Fed's so-called dot plot, that enigmatic constellation of projections that encapsulates the collective wisdom of its policymakers, offers a glimpse into the path forward. While it portends 3/4-point rate cuts by the end of 2024, bringing the target range down to 4.5 to 4.75%, the relative paucity of projections for even deeper cuts is a testament to the cautious pragmatism that has become the hallmark of this institution. In the grand tapestry of economic narratives, the removal of a reference to a slowdown in the labor market from the Fed's policy statement is a stitch of significance. Job gains have remained strong, and the unemployment rate has remained low, the Federal Open Market Committee declared, a resounding affirmation of the robustness of the American workforce. The markets, ever the fickle arbiters of economic sentiment, responded with jubilation, their ebullience echoing through the canyons of Wall Street. The blue-chip S&P 500 soared to new heights, closing 0.9% higher and continuing a rally that has seen the index surge a staggering 27% since October. The tech-heavy Nasdaq Composite joined the ascent, rising 1.3% in a display of unbridled optimism. The two-year Treasury yield, that mercurial barometer of interest rate expectations, fell 0.09 percentage points to a one-week low of 4.6%, reflecting the market's renewed confidence in the Fed's measured approach. Across the Pacific, the reverberations of this policy statement echoed through the trading floors of Asia, with Hong Kong's benchmark Hang Seng Index leading the regional charge. In the words of Gargi Chowdhury, head of iShares investment strategy at the venerable BlackRock, today's dot plot shows that even though the Fed is expecting faster near-term growth and slightly hotter inflation, there is no change to rate cuts. This, she proclaimed, is a really great outcome for markets, for equity markets and for bond markets. It's a really good outcome for investors. As Powell's measured cadence filled the airwaves, the futures market responded with alacrity, the odds of a rate cut in June climbing to a lofty 85%, up from a mere 65% the day before. It was a resounding vote of confidence in the Fed's ability to navigate the treacherous waters of inflation and economic growth. Ishwar Prasad, a respected professor of economics at the hallowed halls of Cornell University, offered a sage assessment of the Fed's conservative approach. The Fed's conservative approach is being vindicated by incoming data and by financial market participants dutifully falling in line with the Fed's projected path of interest rates, he observed, his words carrying the weight of academic authority. Prasad's incisive commentary cut to the heart of the matter, with no compelling reason to cut interest rates and with the persistence of inflation above target leaving it little room to cut, the Fed's passivity on interest rates seems entirely justified. In this intricate dance of economic policymaking, the Fed's bullish outlook for growth is a counterpoint to the lingering specter of inflation. While projecting headline and core consumer price expenditures inflation to reach 2.4% and 2.6% respectively this year, the central bank also foresaw unemployment edging up to 4% from the current 3.9% level. Yet, even in the face of these projections, Powell maintained a studied equanimity, acknowledging the uncertainty that shrouds the path ahead. "We're going to let the data show. We don't know if this is a bump in the road or something more," he remarked, his words echoing the humility that has become a hallmark of his tenure. The Fed's commitment to maintaining the pace of its quantitative tightening efforts, the process of reducing its bond and mortgage-backed security holdings, is a testament to its unwavering resolve. However, Powell's intimation that it would be appropriate to slow the pace of runoff fairly soon hints at a gradual recalibration of this strategy, though he was quick to emphasize that this does not mean that our balance sheet will ultimately have shrunk by less than what it would otherwise. Matthew Raskin, the astute U.S. head of rates research at Deutsche Bank, offered a succinct summation of the meeting's tone. "The striking thing about the statement is how little change there was. It might be as little change in a statement as we've seen in a while. In this consistency, one can discern the Fed's steadfast commitment to charting a course that balances economic growth and inflation control. As we traverse the winding road ahead, it is evident that the Federal Reserve's approach is one of prudence and foresight, tempered by a willingness to adapt to the ever-shifting economic landscape. In an era where certainty is a fleeting commodity, the central bank has emerged as a bastion of stability, its policies shaped by a judicious weighing of data and projections. Yet, amid the technocratic discourse and the intricate choreography of monetary policy, it is essential to remember that at the heart of this endeavor lies a profound concern for the well-being of the American people. The pursuit of economic growth and price stability is not merely an exercise in statistical manipulation, but a sacred trust, a commitment to safeguarding the prosperity and financial security of families and communities across this vast nation. As we gaze into the future, let us embrace the wisdom of the Federal Reserve's measured approach, a strategy that seeks to harness the indomitable spirit of American enterprise while tempering the excesses that can undermine our collective progress. In this delicate equilibrium lies the promise of a resilient economy, one that can weather the storms of uncertainty and emerge stronger, more vibrant, and more equitable for all. For it is in the crucible of challenge that true greatness is forged, and it is through the steadfast stewardship of institutions like the Federal Reserve that we can navigate the choppy waters of economic upheaval and emerge triumphant, our sails filled with the winds of prosperity and our course set towards a horizon of boundless opportunity.